Hi, everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Robert Beardsley. Robert has overseen acquisition and capital markets for Lonestar Capital and has acquired over 300 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published a number one book on multifamily underwriting, the definitive guide to underwriting multifamily acquisitions. Welcome to our show today, Rob.
Thank you very much for having me.
Thank you. So I love kind of getting into some more deep diving on underwriting, etc. But we always ask our guests this one question when we first started: is growing up, who actually influenced you and influenced you to become the entrepreneur who you are today?
Yeah, that's an interesting question. I think there's a lot of nature and nurture involved for most people that really go down any path. So there was definitely an entrepreneurial streak in me just as the way I was born. But I think my family, specifically my parents, did a fantastic job cultivating whatever my curiosities were. And so my dad was always a big role model in terms of just how hard he worked and the principles that he instilled in me in terms of delayed gratification and thinking long term and things like that. So I think that was the big role model for me.
That's awesome. And tell us a little bit more about your path to be this entrepreneur who you are today.
Yeah. So I took entrepreneurs take fairly unconventional paths. So my path is fairly conventional for an entrepreneur, you could say, in that I originally went to school for computer science because I grew up in Silicon Valley. My parents pushed me towards getting a job in tech because they thought that would be the most profitable way for me to go. But while I was in school, my entrepreneurial bug really hit me, and I just was always interested in investing in real estate. I'd always believed in the fact that all roads of wealth lead back to real estate. It doesn't really matter how you make your money. All wealthy people end up investing in real estate one way or another. And so as I was studying more and just following my intellectual curiosities, I just kind of thought, well, why don't I just skip that step, rather than just, waiting to get rich in tech or something like that and then investing in real estate. Why don't I just invest in real estate right now? And that's when the entrepreneurial bug really hit me. And I started pursuing multifamily specifically, got a mentor, met my business partner, launched Lonestar, and then dropped out of school, closed our first deal, and then we just continued building the business from there. And like you said in the intro, since then we've acquired 300 million in assets, and it's been a great ride so far.
That's awesome. And how did you grow so quickly within such short period? Is there like a key kind of attributes to your success over there?
Yeah, it's funny when you're working day in, day out, it doesn't feel quick, right? You're putting in all this effort, especially early on, because early on you're putting in all this time and effort and you don't really see equal result out, right? You're putting in, and there's not really much coming out yet because you're just still getting the ball rolling. But then eventually you get momentum, and then all of a sudden there's a whole lot coming out and you don't have to put as much in anymore, right? So I think the keys to our relatively quick growth has been relationships. And that's obviously cliche, but it is true. We're very meticulous about the way that we are perceived, the way that we present ourselves, and the way that we treat others. We want to make sure that people have a good experience with us because that's how you get repeat investors, repeat sellers, repeat brokers, right? So we really focus on making sure that we are providing a great experience to everyone around us because we know that that's the key to quicker growth. Because if you have to go out and find new investors for every deal or build a relationship with a new broker for every deal, that's a lot of work and that's going to take a lot of time. It's so much faster and easier to close a deal. Everyone had a great experience and everyone says, yeah, let's do that again. And I think that has been a big contributor to our growth.
Yeah, that's awesome. Now, I'm going to ask a little bit unconventional question. Looking at you, a young guy like you, I do know that in this industry, like ageism is a thing. Like people, especially when you're talking with investors, like, wow, Rob, you look so young. How do you actually attract your investors? How do you kind of combat that little bit of short stick that you're dealing with?
Yeah. Certainly, when you're talking about money and investing, people feel a lot more comfortable with someone who's been around the block. They have experience, and investors are very honest with me. They say, I mean, not all of them, but some investors say, hey, you probably weren't even alive back when XYZ happened in the market. So how do I know that you're going to be prepared for a recession or rising interest rates or, different things like that. And it's a very valid point. And to add on to that point, the amount of time that it takes to truly have experience in this business is a very long time, right? It's not like building a house, right? Building a house may take 6 months, a year, or whatever it takes. You can get that experience in a relatively short amount of time, but to actually have full cycle experience, that can be 10 years, 15 years. So it really takes a long time to have a big track record in this business. So certainly that's why ageism, like you said, plays a role. So I think for me, just being honest and open with my limitations and not trying to pretend that I know everything or, I know what to do and things like that. Just being honest, I think has done us well, and humble, right? We're not trying to be something that we're not. We're not trying to pretend that we have gray hair and that we've been doing this for 40 years. But I think a lot of people like the young approach because it is humble, it is hardworking. We can approach things with fresh eyes. And I think to some extent, our investors are the ones with the experience and the gray hair, and we can listen to them. And that's exactly what we've done. And we've learned a lot from our savvy investors who we seek guidance from. So if they're willing to bet on us, we're willing to listen and work hard for them. And so far that's worked out really well. And the other thing also, just to add on to that, my business partner is kind of the one who I lean on for a bit more experience and gray hair if we need it, because he's a bit older, is a tax attorney, he's got that pedigree. So that balance between my older business partner and my younger self has been a really great partnership.
Yeah. So it's kind of finding a key partnership that kind of completes you and bring something different to the table. Awesome. And how did you find that partnership?
We were very lucky to have met each other the way we did. We found each other through a mentorship program. We met at a conference, and it was just very casual. Neither of us were necessarily really looking to launch a partnership, but it was just really right place, right time. We were both in that moment where we could kind of use someone to balance each other out, like you said, and complement each other and motivate and take a leap of faith together, take a big risk, right? It's a lot easier to take a big risk if you kind of have someone that's willing to ride along with you.
Yeah, definitely. So how did you guys start your first deal?
So our first deal, we really just jumped into it. I think that was a big function of just being naive, right? Being new. And we just thought, well, hey, we'll just do this. We'll figure things out along the way. And thankfully it worked out. But there's certainly there's a lot of mistakes that we made that we could have avoided if we would have prepared more and kind of taken our time. But, that's just the way things go in entrepreneurship, right? If you maybe don't take the massive action, maybe you don't take any action at all. So, at this point, we're extremely thankful that we did take the leap and put ourselves in that difficult situation of, we were forced to learn things very quickly. So basically we put a $16 million deal under contract. We put up hard money, and then the clock was ticking. We had to find a loan guarantor because we on our own would not qualify for the loan. That's a nightmare. We had to find a property management company. We had to find a lender. We had to raise the equity and, actually go through the due diligence and put the business plan together and close. And that's just a ton of stuff. When people think about buying real estate, they don't really fully realize how much work it is. It sounds kind of simple. Well, you just buy this building and, there's a manager and you collect rent, but there's just so much paperwork. There's so many people involved, lawyers, different parties. So it really is a ton of work. But we just, like I said, we just went for it, and we worked really, really hard to get it done. And because our back was against the wall, we had hard money at play. So if we didn't close, we would lose a lot of money. And obviously nobody wants to do that. So it just forced us to, particularly on the equity side, really grow our network. Because the problem that we had was that neither of us, meaning my business partner and I, really were excited about raising capital. We didn't really like the idea of selling to investors, and that was not where our passion was. We wanted to do deals. And we kind of figured, hey, if we have a good deal, the money will come, right? And that's kind of a big saying in real estate, but in my opinion, it's a big myth. It's totally wrong, because the money just doesn't magically appear, right? It's about the relationship. It's about building the trust. And I always say this, it's about digging the well before you're thirsty, right? If you have the deal under contract and you want money now, it's too late. You have to be talking to investors and cultivating that relationship before. So that's what we didn't do, and we paid for it. We had to scramble for the capital. We had to get lots of extensions with the seller. We had to give away large portions of our fees and the promote to other partners to help us bring capital because we were desperate. We just didn't prepare well. And that really taught us a lesson moving forward to just really make sure that we actually build things the right way.
Yeah, definitely. That's awesome. Thanks for sharing that. There's a lot of insight in things that you learn. So moving from there, what are then some stuff that you strategically put in place so that you feel like, hey, my capital can now keep up with our deal flow? And that's an equation. It's never exactly the right amount. Like, we understand that.
Yeah, and it's never enough, right? You can always improve and you can always add more fuel to the fire. But it's a great question because there absolutely is a system. And the best way to go about it is to build a system. So what we set out to do is buy into the process of thought leadership and start creating content and giving value back to the community, showing our expertise, being a thought leader. And we did that through podcasts just like these. I published the #1 book on multifamily underwriting, which you mentioned in the intro, which has sold over 5,000 copies. That has built a ton of relationships for us and established a ton of credibility for us, right? They say, a book is an oversized business card, and that's absolutely true. Being active on LinkedIn is a great way to go. And then as you're putting yourself out there, what do you want people to do, right? After they see you on a video or a podcast or read one of your articles, there needs to be some sort of call to action so that if they are interested in learning more, they can actually join your tribe and enter your world. And so the way we do that is, we have giveaways. For example, we give away our underwriting model that we use to analyze property, and we just give that away to the public for free, whereas many other models are sold for hundreds of dollars.
Yeah.
So that attracts a lot of people into our world and again establishes credibility. And from there, that's how we can kind of maintain and build our network. So that is really the infrastructure that we built to facilitate a structure and growth in terms of our equity relationships.
That's awesome. And do you have any employees right now? You still kind of just working with your partner? How did you kind of slowly build up your team?
Yeah, I love this topic. We currently have 5 employees in New York. So that's kind of the core team. And then we also have a group in Houston. As I mentioned, we're vertically integrated. So we have our own management company that we run based out of Houston. So there's a team down there that's responsible for overseeing the properties and all the on-site employees. So, that's quite a lot of personnel, especially on the management end. Obviously I'm not interacting with all the management personnel as far as leasing agents and maintenance and property managers, but our team is responsible for them. And that is definitely a super important role. And as far as how we grew, our first hire was someone to help me on the acquisition side in terms of underwriting, broker relationships, essentially handling acquisitions. And I think that's a logical first hire because there is no money without deals, right? You have to do deals. And I think that makes more sense to kind of firm up your deal making capabilities rather than your, let's say, equity raising capabilities, because delegating raising equity is very difficult because when people are investing, they're investing in you. So it's hard to say, hey, invest with me and then go talk to this guy. It's what you have to do in order to scale. You have to bring on help. You can't be the person that talks to everybody. But I think starting out, especially when you're starting out, it has to be you that is the one kind of pitching deals, talking to investors, networking, building relationships. So the first hire was on the acquisition side. The second hire was on the asset management side, because now with acquisitions, all of a sudden we're buying deals. And now we've got all these things happening. As you know, there's a million things happening, from fires on the property to, just simple collecting rents, CapEx, renovations and everything. So we hired an asset manager to really help on the operations side. And then from there, we were ready to add fuel on the fire by helping on the marketing and investor relations side, going back to my comments about customer service and making sure that everybody is happy. You have to invest in investor relations. It's super important.
So that's awesome. And then you had $300 million in portfolio size. Can you kind of get into a little bit more detail? Because I'm assuming you didn't just vertically integrate from day one. And where is that transition period or the realization I got to be vertically integrated? And why did you take that path? Because you could also, the other model is also hiring a third-party manager.
Right. Yeah, this is another really good topic because we were a bit unique in the fact that we vertically integrated pretty early on in our growth, whereas most firms vertically integrate when they have a bit more scale. So typically speaking, well, so first off, to break even on your property management business in our space of Texas workforce housing, you need about 800 or 1,000 units. And that's exactly where we vertically integrated. We vertically integrated with around that much. And most people, I would say, vertically integrate at 2,000, 5,000, 10,000 units, when they're a lot bigger. Because at that point, building your own management company can be a profit center. But right now, we're not making any money on our management. We're losing money on our management because it's small. But the reason why we do it is not for profit, but as a risk mitigant. We do it for more control, for more transparency. And our investors really appreciate that. And it, even though that we're not necessarily making money from the management, we can argue that we're able to raise more capital because of the management, right? And we're able to operate our properties better because of the management. So even though we're not directly making money from the management company, we are making money from the management company, right? As when we look big picture and look as a whole. So that was really our motivation. And so far it's worked out super well. We were very patient in the way we did it. We didn't just go, oop, now we're our own management company, right? We of course started with third party, slowly kind of learned, built out the infrastructure, made sure that the accounting was in place, made sure that the reporting was in place, and the kind of the top level oversight personnel, as well as the property management software. So we wanted to make sure all those things were squared away so that when we made the transition, there was as few moving parts as possible.
Yeah, because and did you retain kind of mostly your on-site? That's kind of how because one thing that people feel daunting, like I love that you talked about all these corporation level of things like the software, the accounting, and et cetera, which is oftentimes the challenges with third-party PMs. But the big daunting part of it is like a people managing, because each site you're going to have multiple employees, and how do you actually manage all of a sudden going from 5 people company into 50 employees, because the on-site personnel that is required to maintain the property.
Right. Yeah. And you bring up, as far as personnel, right, you have to have full HR, payroll capabilities and things like that, because at this point we do have 50 employees roughly under that payroll. So it's we were very lucky, like you said, to be able to retain essentially all of the people when we made the transition. So I think people are the most important part of certainly the management business and pretty much all businesses.
Definitely. And then why did you decide to publish the underwriting book? Because it seems to be a very niche topic. Is there a strategic thoughts behind why that particular title, why that particular niche?
Yeah, when it was very weird to me that a book like this didn't exist. It kind of felt like so for me, when I started in the business, I felt that I'm a numbers guy. So for me, it was the natural place to start. In order to understand the business, I felt like I had to understand how these deals work and how do you make money? How do the deals make money? And what drives the numbers? So I really dug into the underwriting and understood the inner workings of the financials and the valuations and the debt and the equity, and became an expert in that. And I really, for the most part, taught myself, right? I would just kind of look for resources, as well as learn on the job, as well as talk to people who were experts, such as lenders and investors, brokers, property managers. And through that process, like I said, I really became an expert, but it was such a circuitous route. It wasn't just a straightforward, read this textbook and now you're done.
Right.
And I felt that it would be a great way for me to give back to the community, to kind of look back on where I've come and just be able to give people a shortcut. So that was kind of the inspiration behind it.
That's awesome. How many units do you have right now with that $300 million portfolio?
2,500.
Yeah, that's quite a big operation. So what do you kind of see yourself kind of like in the immediate 1 year goal, essentially, whether it's growing the business or revenue or unit counts? What do you kind of see yourself there? And then what is the median length goal, like 3-5 years, essentially? Yeah.
So, we're right now at about the middle of 2022. and we have an ambitious goal to close 300 million in assets for 2022. And we're with the deals we have under contract right now, we're at 175 million. So we're roughly on track. I think we should be able to hit it, but it takes a while to close these deals. So there's definitely a lot of work to be done. So that's the kind of the number one goal as far as acquisitions. On the operational side, our number one goal is to hire a construction manager and bring more aspects of the construction side in-house. That's going to further help with cost control, with mitigating risk, and speeding up the construction process. So we're really excited to roll that out, and that's a major initiative. So those are the short-term goals. And then medium-term goals, of course, and also, especially when you talk about acquisitions, so much of that is out of your control, right? The market could change, deals could be tougher to do. There could be kind of like a freeze period, the way there was for us during COVID, where we didn't buy a deal after COVID for all of 2020. So we just never know, right? But obviously we have our goals and we want to be ambitious and we want to make things happen. So for 2023, we'd like to acquire 500 million in property for the year. Which will be very difficult to do. We're going to have to find new ways to either acquire more property or acquire larger property, and that's really the only two ways to do more. So that's I like setting goals that make you think differently, right? If you set a goal that just means, hey, run a little faster, well, that's kind of a simple goal, just run a little faster. But if you set a goal of, I want to fly, right? You can't just run faster to fly. You have to program your thinking and think of a completely new way to operate. So I think those are the ways you make the big breakthroughs. So that's where we're at right now.
Yeah. And then what's the cause? Is there like another underlying drive and a cause for this rapid growth?
It's a challenge. I think in some ways, I think by and large, it's just the thrill of entrepreneurialism and growth. Growth is exciting. But to kind of speak more realistically or more pragmatically, growth enables proper scale, where it's almost like when you run your own business and it's small business, the business runs you. You're kind of like a high paid employee and you're running around crazy doing everything yourself. And it's really a nightmare. Whereas a big business, you can hire more people can work for you, and things just run better, right? You can build more systems. Right now we're running, I hate to say this, but we're running based on the talent of our team. We have a very talented team. We're a small team. And while that works well, it's dangerous, it's risky. The better way to go is to establish systems so that things don't fall through the cracks, right? Rather than having to rely on everyone remembering things and just knowing how to do things, right? What if somebody is sick? What if somebody leaves? And then we kind of have to start over, right? So building systems is really that next level of institutionalizing our company. And I think that's kind of one of my goals as far as rapid growth is we need to get to being like a real company as fast as possible. So that way we de-risk things and we can kind of run more smoothly.
And so what are kind of like some of the thoughts? Because I think I kind of grasped your goal over here is kind of almost like a double the year the one before. Now, you did touch on COVID conditions, and then with our current market, there's a lot of volatilities and et cetera. How do you kind of pivot around, and what kind of parameters of selecting the properties and et cetera are you kind of implementing to essentially limit the exposure to the downturn?
I would say the single largest thing that we are doing in response to today's volatile market is lowering leverage. So traditionally, we've been a max leverage borrower, whether it's agency or bridge. We've been lately borrowing 80% loan to cost bridge loans, and that's all out of the window. Today, we're borrowing at 65, 70% leverage, which is allowing us to borrow at more flexible terms, more favorable rates. And that's what's de-risking our investments more than anything else. I mean, obviously we can do our best to buy in quality locations that are going to be resistant to a downturn. But I think more impactful than that is just lower leverage. With lower leverage, all your risk metrics go down.
Then lower leverage actually requires you to raise more money. So obviously, as a company kind of doing through the rapid growth, because I say that, we're kind of on that path too. So I totally feel the burn of like, it used to be like, hey, not enough deal. But now all of a sudden it's like not enough capital. So, is there like certain things that you're doing to fundamentally changing the top of the funnel investor in your marketing funnel investors and then or the conversion?
Yeah, I don't think so. It's a valid point. I mean, obviously,
Hmm.
it's a lot more equity that we're raising, which is unfortunate because I mean, depending on your deal structure, it could be compensated more or less based on the amount of equity we raise. But traditionally speaking, right, if you're getting paid on an acquisition fee basis,
Hmm.
you don't get paid more or less based on how much equity you raise, right? It's the deal
Hmm.
size.
Hmm.
So if the deal size is the same, but the LTV is lower, so the equity is higher, right? You're doing almost double the amount of work on the capital raising side to make the
Hmm.
same amount of money. So it is a lot more work that we're doing now to raise more capital, but I think it's the smart, safer approach.
Hmm.
And at the end of the day, we need to be thinking long term for our investors because we can't just be thinking about getting one deal done. We can be
Right.
thinking about getting 50 deals done with our partners over the next however many years.
Hmm.
So yeah, I can't really say we've changed anything on the marketing side because of this. We're just being consistent and growing the network and just having to raise a bit more money.
Yeah. And then from this doubling sizes or the amount of acquisition, I mean, part of it is market inflation is helping you with that goal, because it's already making you 8% increases, which some said maybe a 20% increases in inflation. But then on the other hand, too, is in terms of the amount of deals that you do, are you looking for larger properties to essentially do that? Are you kind of focusing on, hey, I'm gonna building our team, the system, etc., so we can take a double amount of volume? Like, where are you kind of thinking about that? Is there any criteria changes on your acquisition?
Yeah, we have slowly increased our deal size minimum,
Hmm.
and it's a flexible minimum, but we would like to be buying larger and larger properties if we
Hmm.
can, right? Because at the end of the day, buying a deal is pretty much the same amount of effort,
Yeah.
whether it's a $30 million deal or a $300 million deal. So, we're certainly not ready to buy a $300 million deal, but we would love
Hmm.
to at some point. I think increasing the minimum is a prudent thing to do in order to achieve our goals. And then, like you said, building out the team in order to be able to handle more deals. Because it's not just because when you actually start thinking about the desire to, let's say, buy 10 deals in a year, for example,
Hmm.
that means you're going to have 3 deals happening at the same time
Yes.
most of the time, right? it's
Yeah.
it's we're just now getting used to having 2 deals happening. We pretty much, so that for the last, I don't know, I'm gonna say maybe 8 months, maybe
Hmm.
7 months, we've had 2 deals happening at the same time,
Hmm.
nonstop. And we've kind of gotten used to that, right? At first, my brain didn't work. I would talk to an investor and I could only remember the details about one deal. And then all of a sudden I can't flip back and forth and talk about this deal right? I only can remember the unit counts,
Yeah.
the returns. But I've kind of gotten used to that where I can kind of flip to deal. And we've kind of figured out how to handle the transaction process for 2 deals at the same time. But
Hmm.
now we're gonna have to figure out how to do 3 deals at the same time, right? And that requires, like we discussed before, systems. You need to
Hmm.
have clean, organized systems, and then team, right? You
Hmm.
can't do it all yourself. So we need to hire more people to help vet deals. You can't spread yourself too thin because then you're going to let deals slip through the cracks. You can't manage the relationships the way they need to be managed.
Hmm.
So those are the, you're kind of getting me excited and nervous because these are the number one priorities for us to be able to actually reach our goals.
Yeah, that's awesome. Well, that's awesome. And I guess like we kind of talk about the medium goals and etc. And where do you like if money wasn't a subject, and I don't think it does right now, really, but what would you rather do? Like if you're looking at your role currently inside of the company, like on your next level of business, what would you rather do and let go of some of the duties that you're doing right now?
So I think for me, the my evolution was starting out. I underwrote every deal. I talked to all the brokers. I would put the deal together. I put the
Mhm.
pitch deck together. I would pitch the deal. I would help with raising capital. I'd help with closing, and that's a lot, right?
Mhm.
And now I've been really
It's like
lucky to be able
everything.
to. I've been really lucky to be able to build out a team to help me with a good portion of that. To now where
Mhm.
I've really put on my capital raising hat and I can really focus on raising capital.
Mhm.
But the next level for me will be to build out a team, a business development and an investor relations team to
Mhm.
help kind of systematize and institutionalize that aspect. So I don't have to be running around remembering everything in my head. What did that investor say? Are they in? Are they out? What
Mhm.
information do they need? What do they like? And that will be kind of the next step to kind of be able to rise above that, manage that team, manage the acquisitions team,
Mhm.
and then help continue to have a vision for the future.
Yeah, that's awesome. Well, I learned so much from our interview today. And thank you so much for your time, Rob. And I think our listeners definitely learned a lot about building business and the writing. Now, how do people find out about you, about your company, and then reaching out to you?
Yeah, so listeners can learn more about us at Lonestar Capital on our brand new website, which is at lscre.com, which just stands for Lone Star Capital Real Estate. So that's lscre.com. On our website, as I hinted at before, we have a free giveaway for our underwriting model. There's a ton of resources as far as videos and articles that are no fluff, packed with good info. So feel free to check those out and reach out through the website if you want to connect. Also, I post daily on LinkedIn and I'm very active there. So feel free to connect with me there and message me on LinkedIn.
Awesome. Thank you so much for your time, Rob, today. And this wraps up our another episode of 10,000 Roads to Financial Independence.
Thank you very much.